Good afternoon, everyone. I welcome you all to today's webinar. We have with us Dr. Jinesh Panchali, who will be leading today's webinar. He has over 30 years of experience in academic consulting and academic administration and is currently associated with NISM. He is well known for his deep knowledge in finance and strategy. Dr. Panchali has done his MBA in finance, a PhD in management from the MS University of Baroda, and he is also a cost of management accountant CMA. Before joining NISM, he managed his advisory firm Arham Advisors and has worked on projects in areas such as merger and acquisitions, corporate valuations, and management information system. He has also served as dean at the Indian Institute of Capital Market IICM and as senior vice president and head of knowledge management at Financial Technologies Group. He has shared his knowledge on topics like M&A, corporate valuation, and restructuring at various IIMS and national level institutions. He has also worked with ministries and regulator on several national and international assignments in the area of governance, venture capitals, and capital markets. We are truly honored to have him with us today. About this webinar is being organized under the Financial Education Initiative of the National Institute of Securities Market NISM, which is supporting today's session. NISM is a public trust established in 2006 by the Securities and Exchange Board of India (SEBI), the regulator of the securities market in India. The institute carries out the wide range of capacity building activities at various levels, aim at enhancing a quality standard in securities market. Before we begin the session, I would like to share a few important points with all participants. Questions will be taken at the end during the question answer segments. All participants will receive their certificates within 3 to 4 working days. The recording of the session will be uploaded on the official NISM YouTube channel. Now, without taking much time, I would like to hand over the session to our speaker, Dr. Jinesh Panchali, sir. Thank you.
Thank you, Namrata, and good afternoon to all the participants who are attending this webinar. I hope I am audible to you, and in case if you find any lack of clarity, let me know. The agenda for today's webinar is corporate governance, protecting investors' interest. So I have tried to cover this particular topic in the following manner, which is visible to you on your screen. I would spend some time, perhaps 15 minutes, on the corporate governance, the evolution of corporate governance, meaning of the corporate governance, and what exactly the corporate governance does to the company. And then we may look at the investors' protection, some of the governance issue, and therefore the mechanisms which the regulators, policymakers have made in protecting the investors' interest. So this is the flow of my presentation. In case if depending upon how I'm able to cover it, we will go through, and then I am told that I have to stop at 16:45, and then we will take up a few questions if you have. The origin of corporate governance is perhaps dated back to the war of or the epic of Mahabharata. The kind of dilemmas both the sides have faced during that time. Perhaps a CEO or executives of the management team faces similar kind of dilemmas and then they have to chart their way out in fairness, yeah, in order to maximize or in order to work in the interest of the company. Yeah. I will just read some of the quotes which are generally taken uh, from the Mahabharata and Chanakya. Chanakya is considered to be the greatest economist and the strategist of India, and their shlokas or verses are still relevant today in the current world, in the current contemporary scene also. He says the wise should work without attachment for the welfare of the society. This is what the Krishna says. That karmaniyavadikaraste ma phaleshu kadachina, but that is for the society. The second one, which is very apt today, is the trust must be protected by the leader at any cost, especially in the financial markets where the domain in which the NISM and SEBI operates. The trust is a very, very important and a critical factor. Yeah. Trust must be protected by the leader at any cost and should be prevalent in the market. Otherwise, the market will collapse. So we will see some of the regulatory mechanisms, some of the regulations which are essentially ultimately uphold the trust in the market. Another is methods and techniques of governance can be learned from the text, but the wisdom comes from the experience. Yeah. So you may find the people who are at the guard of governance, yeah, they are fairly experienced in the field. Yeah. So not only they know about the concept, theory, and techniques, but they also able to appreciate and understand how these things are applied with the wisdom. Yeah? There is no customized solution to the governance specifically. It is based on the situations basically. Yeah. So origin we can date it back to the this kind of epic literature, and little later on the after a few years, few centuries, in fact, the Chanakya, who was the greatest economist and the strategist, has come out with various verses. The purpose and meaning of the corporate governance, Sir Adam Cadbury, yeah, who was considered to be the father of the corporate governance, has defined corporate governance as the way the company is governed. Yeah. But at a macro level, it requires to promote for the policymakers. The aim is to promote economic efficiency, sustainable growth, and the financial stability. That is what is the ultimate outcome of collective corporate governance in an economy. Economic efficiency, and therefore we look at the shareholder value or the value creation, sustainable growth. That means essentially we are looking at the long-term sustainable growth and not the short-term maximization. And finally, adding to the dealing with the risk or giving some solution to the managing the risk, there has to be financial stability. Though the world is fairly dynamic, you know that these days uh, geopolitical risk has been changing dynamically, perhaps day by day. You know? So the governance is required to promote at a broader level, is required to promote economic efficiency, sustainable growth, and the financial stability. Company as a form of organization is a kind of a contract, yeah, with a lot of stakeholders. Some of the main stakeholders are the company's management, company's board, shareholders, and the other stakeholders. So these stakeholders, as a collectively we can say, have often conflicting objectives, and how the company as an entity manage this relationship, yeah, in order to further its outcome, in order to further its end outcome. Yeah, that is what is corporate governance. How it is done. It provides the structures and systems through which the company is directed, objectives are set, and they are achieved. Yeah, company is directed generally. I mean, as you all might be knowing, the company is a corporate form of organization. Yeah, has evolved largely from the industrial revolution. Yeah, where the scale of operation has become multifold, and when this scale becomes very large, it is difficult for a family to manage the risk. You know. So risk needs to be cut into the pieces so that the individuals coming together and bear the risk of the scale of operations. And that's how the corporate form of organization has come into picture, has evolved. Yeah. But as they have managed, yeah, to take the risk piece by piece and create a very large owner's capital, yeah, it comes with a cost. The cost is essentially the diverse of the ownership and the management. Yeah, so we found that the risk is divided, but then who will manage? Uh, you can't expect some 10,000 or 1 lakh or even 100 lakh owners coming together and manage. And therefore, a management group, the stakeholders call a management was formed, the professional management, the owners entrusted the management of the company to the management group, and they were become the agents of the owners. Again, company as a separate entity, it has to manage, it has to take decisions, and it is a mix of various shareholders, and therefore the mechanism of the board came into picture. Yeah, the board came into picture as a collective mechanism where it is considered to be the decision making point of the company. The board may consist of the various kinds of directors, shareholders, directors, independent directors, executive directors, non-executive directors. Board collectively take the decisions and govern the company. Uh, so that is a root cause of uh, uh, the popularity of corporate form of organization. Once this came, along with the diverse of ownership and control, that created the need for the better corporate governance, how this various resources are to be governed and managed, not by the owners, but by the agent of the owners. And what is to be maximized, what is to be taken into consideration when the company is to be managed. Yeah? How the objectives are to be set. Objectives are to be set for the shareholders, which is the owners. I mean, that group of stakeholder is taking the maximum risk. They have come together and taking the risk. I mean, bearing the residual risk, whatever be the profit or whatever be the losses. And once these objectives are set, considering to whom the company should serve, how they are achieved. So before going to the next slides, purpose and meaning is at a broader level, at a policy level, it is to promote economic efficiency and sustainable growth with the stability. The governance is the way the company is governed, and it's a network of relationships. Yeah. Company is a network of relationship, and therefore it has to balance the interest of the various stakeholders. Basic tenets of the corporate governance, the purpose and direction. Uh, if if someone asks me what is the core role of the governance of the company, is to to direct the company, you know, to, to formulate the strategic direction of the company. I mean, to me, the risk management, the compliance, all other things will come later. The board has to first look at the strategy of the company, how the company can be steered and in which direction. Uh, So the purpose for the corporate governance, and particularly as it is, as I said, corporate governance, the board of the company is to first formulate the strategy. It's first to work in the interest of the company, and then all the stakeholders will come. Yeah. The second is accountability. So once you have been entrusted the corporate resources, yeah, like a huge, if you might have raised funds from the IPO, you are accountable to the to those who have given the funds and also to the company, yeah, who has taken this fund. So performance of how these funds are put to use, and therefore the performance of the company along with the risk. uh, the risk should not be disproportionate to the performance. So one has to manage the risk as well as the performance, and there should be alignment. The remaining two are essentially uh, the more of non or a qualitative virtues kind of thing. Transparency. Since you are in a fiduciary capacity, the board of directors, collectively the directors, are in a fiduciary capacity. Yeah, they are managing or they are taking care of the funds provided by the owners and giving it to the management and see how the management are, are using these funds. And therefore, since the owners are not there, so they have to be informed about how the companies companies working. Yeah. So therefore, there has to be transparency. As a market regulator, as a policy making body, yeah, we should take care of the interest of the investors, those who are not directly in link with the company as such. Yeah. So how the transparently the company is working, and therefore we have a huge set of various disclosure requirements, particularly the LODR, CB LODR, which requires company to disclose. Yeah. One is timely, another is relevant disclosures, and it has to be a material disclosure. So this is one of the very important part that create a trust uh, on the shareholders that yes, this is what the company is doing, and this company is informing us in a timely manner. The fairness is again a very important part. Ethical behavior should be fair to the various stakeholders. I'm not saying that you give an uh, excessive treatment, yeah, either positive, generally the positive. Yeah. No, it has to be fairness. All the stakeholders are to be treated fairly in your operations. The people should appreciate that if this company is there, then it will operate fairly. Yeah. I remember a couple of examples of Tata's, yeah, of Infosys. Yeah, they have created a culture of fairness that whatever projects they will take with the fairness. Yeah, whatever they do, they will do it with fairness. And then finally, I mean, which is called a compliance, which has become generally take a lot of time of the company, which is important also. But in a priority, the compliance, in according to me, is not at the top. Yeah, the compliance is necessary because the rules are created for the system to run, and therefore it needs to be it needs to be complied with in spirit rather than letters. Yeah, we find many a times these are being done in letters rather than spirit, but the compliance should be in spirit. The rights of the shareholders, rights of the stakeholders need to be protected under the complying with the laws of the land, particularly when it comes to the corporate governance. It is to be with the, the various laws. I will go hurriedly with the corporate governance evolution. The Cadbury Committee was the first one in UK, yeah, which had been constituted to look into the role of originally the auditor and then expanded to the various other stakeholders. Then in 1992, the UK in UK, the Cadbury Committee was constituted. In India, it started with CII code, yeah, CII task force. which was headed by late Mr. Rahul Brajaj. After that, the Kumar Mangalam Birla Committee, then the clause 49 of listing agreement, standing committee on the directors, then amendment to the 49 of the listing agreement, Naresh Chandra committee report 1 and 2, Narayan Murthy committee report, which came out with mandatory recommendations, non-mandatory recommendations, Irani committee. Satyam irregularities, this is not very positive, but this has instigated, or perhaps this has uh, instrumental in, in making the people aware of the corporate governance. So that had played an important role in revising the various guidelines for the corporate governance. CSR made mandatory. Perhaps India is one of only the country where the CSR has been made mandatory. Consider that the corporate governance is not only for the profit, but the company needs to give back to the society in which it operates and from which it takes the various resources. We have seen LODR accounting standards in India standards and secretarial standards, which play a very important role in the corporate governance. In 2016, uh, the way there has been a market for corporate control by the shareholders, the insolvency and bankruptcy co give that kind of a power to the creditors, yeah, by having a provision of having a credit committee of creditors who will decide the fate of the company, yeah, whether it is to be liquidated or whether it is to be resolved. Yeah. And then finally, the Uday Kotak committee has revamped the scene of the revamp the various provisions of the corporate governance on India. Yeah, I'll go a little hurriedly. These are the various shareholders, the types of shareholders which are with a different objectives becomes the owner of the company. And out of this set of shareholders, some of them and many of them will collectively represented by the directors on the board. So this shareholders, though it is a one class which has a right over the residual profits of the company, but they do have a complex set of short-term uh, short-term interest and the long-term interest. Yeah, some may have fairly long-term interest, and they may look at the company's existence on a long-term basis. Some may have a little medium-term objectives to be with the company. Yeah, and will have to exit often. Yeah, like sorry. PE and VC, they have a long term up to 5 years, 6 years, and then they have to exit because they have to return the money returns to their own unit holders. Perhaps with another fund, they may recycle it, but yeah, they have this kind of interest, the interest for the age life of the fund. Yeah. These are the various stakeholders of the company. Yeah? And shareholder is one of the stakeholders of the company. It can be the management, lenders, society, employees, vendors, customers. No. The company exists for its various stakeholders. You know, you can't say that since the shareholders have taken the residual risk, the ultimate risk, the company should work only for the shareholders. The company has to take care of the interest of the lenders also, society also, employees also. Employees also one kind of a factor of production, the way the capital is. Yeah. So suppliers also, customers also. You can't charge monopolistic price to the customers, yeah, and say that I have worked in the interest of the shareholders. You have ruined the customers, perhaps the society also. You have to spend, and therefore that CSR has been made compulsory. You have to give back to the society in which you are operating. Yeah. This is how the board has to manage the conflict of interest. But ultimately, it is the interest of the company. Yeah. It is not the shareholders, it is not the customers, it is not the employees. Yeah. It is the company's interest as a whole, survival of the company, growth of the company. That is what is more important than merely the profit after tax. You know. So the governance is essentially, and therefore it is difficult. Therefore, it is difficult. You know, whom, whose interest is prime to the company. Yeah. The Friedman theory was that the profit, you maximize the profit and the profit will take care of other interest. Yeah. But in practice, it becomes a little difficult. If you go for the profits through the shareholders, you may cut corner for the various other heads of the cost. Yeah. It is good that you can work efficiently, but it is not proper that you exploit. Yeah? You exploit the government by not paying tax. You exploit the society by polluting the environment. Yeah? You exploit the society also by not taking care of the, the, the areas around you. So you have to have a balance essentially to have a good corporate governance. And and one of them is investors' rights and protection. If you and that and now we are coming slowly from the stakeholders to the investors' rights and protection, which is also the part of today's topic. Yeah. So we have it is not only for the regulation or a regulatory compliance that we have to look at the investors' rights and protection. It is a strategic necessity. Yeah. You have to have proper investors and investors protection or upholding of investors' rights in order that investors remain with us. Yeah, if the investors will not is not having adequate trust in the market, they will not come back. And the economic efficiency as a whole, the economic growth as a whole, will suffer if this particular thing is not there. So strategically also it is important, and through the various other positives also you require to have the protection of investors' right. Once, I mean, one of them is you should have like transparency in the operations. You may also like if some of the investors or group of investors have higher perspective or better perspective of doing the business. So once you comply or once you allow the investors to be the owner and listen to them about their perspective, it brings in the inclusivity in the decision making. Yeah? It brings the various decision or various perspectives into your decision. And therefore, today we find that institutional investors offer them this kind of perspective to the management, yeah, to the board. Yeah. Board may or may not like it, but institutional investor also have their own perspective, and they being the owner and they being the collective owner, they can influence. They have every right to do that. This also enhances the trust in corporate governance. If you empower the investors, yeah, then it enhances trust. It leads to sometimes it leads to the strategic outcomes. We see that shareholders activism, which has been becoming popular, or rather, in fact, institutional investors activism, yeah, often restrict the company from wasting away, yeah, from flooding away the resources in a particular direction, which a reasonable person would not like to do that. Yeah. It smoothen the corporate actions. If you allow the investors to empowered in their corporate rights, it smoothen the corporate actions. And if people see that you are doing this, you are empowering the investors, you are allowing or you are listening to them, investors, you are ready to engage with the communication with the investors. They offer a premium, and therefore your cost of capital will go down. Yeah. And perhaps the funds, maybe from the other places, looking to the way you work. We have seen the Tatas, we have seen the Infosys, we have seen some of these companies having a higher reputation can raise the funds at a low cost. I will not right now go into the details of this, but these are some of the regulations which are helpful or operated to empower the investors or to protect the rights of the investors. And of them, there are two I find: the Companies Act and the LODR, yeah, 2015, and Companies Act 2013, drawn from the earlier version of 1956. Coming to now linking the governance with the protection. Yeah. One of the important role of the government or the company is essentially to issue the additional shares. Now, when the shares are issued privately, that is one part. And generally, when you have the private placement, it is with the preferential allotment, because you are not giving it to others, but you are selecting some QIB or some group of investors and then giving them the shares. When you do this, yeah, we break one of the rule of the corporate democracy. Yeah, that is when you issue shares, you have to issue it equally, yeah, to everyone. If they refuse it, yeah, then it can be given to the others. But because of the business ease in the business, this is very common practice that you issue shares privately. Uh, what happened to the shareholders when you issue these shares privately? This will change the voting structure, leading to the dilution of that stake. Yeah. And therefore, ordinary resolution is not enough. Yeah. You have to protect the rights of the investors if they have grievances that no, we would like to have or we would like to participate in this funding exercise, and therefore we need to retain the kind of a control that we have pre-issue. Yeah. So therefore, the regulations in the Companies Act as well as ICDR, that is issue of capital disclosure requirements of CB, yeah, require a special resolution, so that at least a larger portion of the investors are with the company in issue of the shares directly. If they have a grievance, they can raise. So that is one part. Second part is even if you allow them or even if you give them a privilege of a special resolution, at what price it has to be given. Yeah. It should not be given to the others at a deep discount. The pricing of the preferential issue is also equally critical, and it is dealt with in a very detailed manner in ICP. So the first part is when you raise the funds for the company, yeah, and particularly when you do this, when you make the other shareholders subject to dilution, then you have to take a larger permission or a permission of the larger group, and therefore the special resolution, and you have to take care of pricing part. This is another example of the governance where the substantial acquisition of share happens, which is a part of the business, yeah, which is the secondary market essentially, which is also considered as the market for corporate control, yeah. Uh, Day in and day out, they see the acquisition of shares, and often the substantial acquisitions of shares, which is potential for changes in control. One is the effective control, and secondly, it is the control by way of acquisition of shares. There is a direct control, indirect control. But when the control is likely to change, yeah, the outgoing management gets an opportunity to get out of the company. But what about the existing shareholders? They would also like to have to take this opportunity. Yeah. The seller will, I mean, the buyer will say, the incoming management or incoming shareholder will say, why should I give this opportunity to others? Because with this partial control, if I can manage the company, if I can control the company, why should I be burdened with the additional cost. No, we are in a shareholders democracy kind of a thing. So we need to give. You have given an opportunity to the outgoing management. You give it to the other shareholders whether they would like to be with you or not to be with you. So fun is through the SAST, that is substantial acquisition of shares and the takeover regulation. Yeah, it is given an opportunity, mandates that that if you are taking over a control, you have to make an offer to the existing shareholders of the company. Not only that, yeah, you can give an offer to at a market price perhaps, or at market price existing at the time of the offer. No, yeah, you might have given premium to that outgoing management. The same premium I am also eligible for. Equality of treatment to all the shareholders, whether you are management or whether you are non-managerial shareholders, retail shareholders, institutional shareholders. Yeah, one, we should be giving that opportunity to the shareholders to be with the incoming management or to go with the outgoing management. Second is the pricing, and that is also very important protection for the shareholders. Otherwise, the shareholders will be left out. Yeah. So that needs to be avoided. Therefore, this SAST regulation is protecting the rights of the shareholders. In addition to that, it also allows for competing offer. It also allows that no frivolous offers are made, because these are very strategic in nature. And therefore, if somebody make an offer and the whole attention focus of the existing management will be to whether to accept or not to accept and other things. So it should not be frivolous. Yeah. So that is yeah. The third one is the right to appoint and remove directors on the board. Yeah. If I am the owner, then I should have that right. Yeah. To put my representative on the board. And if I find that particular board representative or the directors are not acting in the interest of the company, I should have that power to to float that resolution. Then let the outcome be whatever be. Yeah. If I have convinced others, then I will be able to achieve my objective. If I have not able to convince, then let it be. But at least I have got power and I have tried what I wanted for the company, being the owner of the company. Yeah. So shareholders can take part in the decision making. Yeah. If not the removing the director or appointing new directors, it may have to float a resolution which can be go in a normal way in AGM. Yeah? AGM is the platform where the strategic decisions are to be taken. Yeah. So there is a right given to the shareholders, and this right is given to the shareholders to call an EGM, yeah, extraordinary general meeting, yeah, and then conduct its operation, yeah, conduct its resolution, and then see what happens. This is available to the 1,000 shareholders or 1/10 of number of shareholders. No, that is for the shareholders nominee. But for calling an EGM, you need to have 10% of this share capital. Yeah. This was very, you can say, debated and tested in case of LIC versus the Scots Limited, perhaps in early 90s, yeah, when Lord Swaraj Paul, yeah, they used to call him Lord, yeah, so which was bestowed on him by the UK government. But anyway, so there the institutional investors have tried and called EGM. There are recent cases of some entertainment company, the satellite company. The lenders who have invoked the pledges of shares, and then they have tried to call an EGM to appoint their own directors, removing some of the existing directors. So in addition to that, the Companies Act also have the provisions for the proxies. Yeah? The proxies That is, you can give proxy to the competing management, and then the competing management will go to the AGM and try his luck in a sense, yeah, depending upon how much proxies he can collect for the yes or no of the respective resolution, which is. There is also a provision under the 151 of the Companies Act for the shareholders nominee, small shareholders nominee. So those shareholders who are holding investment less than 20,000, they can appoint a nominee on the board of the company. So these are some of the provisions which have been there in the Companies Act, and some of them also get facilitated through the SEBI LODR to participate in the decision making of the company by having the representative on the board. Uh, this is a very recent phenomena where a group of shareholders, if they are not satisfied, yeah, as we see that the single shareholders, it is difficult for them to resist kind of a thing, and it requires kind of 10% of the paid up capital and all those things. Yeah. Then there is a provision which has been introduced in Section 245 of the Companies Act, which says class suit, they are called. And there have been two class suits so far, have been resorted to under this section. Jindal Polyfilms is one for the alleged malpractices or those mismanagement kind of a thing by the promoters of the company, alleged one. Yeah. And in case of ICICI Securities, yeah, after the merger, they want to, the delist and delist the company. And for that, the swap ratio was there, and a group of shareholders were not satisfied with the kind of a swap ratio, and therefore they had initiated the class suits. Both the class suits, essentially the shareholders were defeated, but there has been a provision which has been tested, yeah, under Section 245 of the Companies Act. It's a M&A related or kind of provisions, SEBI circular of March 10, 2017 about the company's scheme of arrangement and compromise, yeah, in which the shareholders or the mergers, acquisitions, restructuring kind of a thing, delisting, all those things are covered under that. So in that, if the company is listed, company that fall under the domain of the, the SEBI, and when some internal restructuring is happening, and by this internal restructuring, if the the public shareholding, yeah, in the post restructuring period, yeah, reduced by more than 5%, yeah, then they're likely to be reduced by more than 5%. Then there has to be that the company has to take approval of that remaining shareholders. The other shareholders, that the promoter group shareholders, will not participate in that. It has to be approved separately by the minority shareholders. So this is something which was introduced lately, and it requires the kind of NOC from the stock exchange, and it should offer various documents like fairness certificate, the valuation report, compliance with Ind AS in the accounting, the financial statements. If you look at any company these days going for merger, yeah, it has to have the NOC from the stock exchange. And you find in that company's website the valuation report, which was generally not available before this regulation came in, or this circular came in. Yeah. So this was also one of the important aspect of the governance. When the restructuring happens, the the ordinary resolution is anyway there. Special resolution is also there, but there is a separate which is called the majority of minority. Yeah, the minority should meet separately, and they should approve this scheme with a majority. Yeah, with 51%. So That is not only has come in form of majority, but this circular has brought in a lot of disclosures and certification, which is helping the protection of investors' interest. I will take this last and then I leave it for the questions and take one more slides. But stewardship code, yeah, which has been introduced uh, in 2020, though it was notified in 2019, but it was essentially become effective in 2020, which says that the institutional investors uh, are not voluntarily, but by these regulations are required to be responsible investor kind of. When I say responsible investor, that means that they have got the rights. Yeah, they have got the rights of the ownership. They have to responsibly, yeah, execute that rights. They can't say, I am not interested, I'm the only investor, and therefore, if I don't like the company, I'll go out, which is a very logical argument for that. But being a responsible investor, you have to perform your responsibility also responsibly. Yeah. So you have ownership right, and these rights needs to be performed. Yeah. And therefore, if the company is not doing well, you have to engage with the company. If the company is not taking care of some of the ESG standards, you have to engage with the company. Yeah. If the company is going diversifying and then you are not agreeing with this kind of diversification, you have to engage with the company. And you have to disclose also, right, that why and you have taken this decision to go with the resolution or go against the resolution, and you abstain from the resolution, that also should be reasoned. Yeah. It's a kind of making the company responsible for the kind of ownership they have on behalf of their beneficiary. Yeah. So the money which they are holding and therefore the ownership they are holding is not on their own. It is essentially a kind of a fiduciary responsibility on behalf of the investors who have given them the money, given them the funds. They are managing others' money. They have to remember and therefore perform some of this responsibility, stewardship responsibility. And if you look at some of the funds disclosures, yeah, it's a detailed voting policy. Then they disclose Invesco, all the institutional investors, they have to follow these 5 principles which are given here, 5 to 6 principles. And how they are following, they have to disclose. So there is a lot of awareness has come up and a lot of engagement with the companies have come up these days. And if you look at some of the reports of proxy advisors also, you find that this engagement and the and not only the proxy advisors, but the large institution collectively. You may see some of these reports for the managerial remuneration. Yeah. They are advising the shareholders that no, don't approve this resolution because this remuneration is excessive. Yeah. It is already 16:50 and I'll go to the last slide. In order to do this, there is a lot of penal provisions which are provided in the SEBI Act, and some of them is very fairly detailed in under Section 1111A and 11B, 11C that empowers the SEBI to take actions and protect or to achieve their objective, which are given in the preamble of the SEBI Act. Yeah, or I mean the protecting the investors' interest, orderly development, and the regulatory. Yeah. So in order to do that, it has various sections empowering SEBI to do that. There are a variety of penalty. One is monetary penalty, another is non-monetary penalty. For many of this civil kind of thing, the failure to furnish information, failure to redress this thing, a failure to obtain certification of registration. Without that, you are still doing the business. Failure to comply with any specific resolution or specific interest instruction from the board. Yeah. 1 lakh per day for the continuous default and 1 crore as a whole, whichever is less. And for violation of 3 critical regulations which are prohibition of insider trading and prohibition of fraudulent and unfair trade practices and SST. There is a very large this thing of uh, penalty. Non-monetary penalty include imprisonment, which is of criminal in nature. Suspension, you may find in many interim orders or final orders of the SEBI, suspension and cancellation of the registration, prohibition from the market access, settlement of the proceedings. You might have recently seen some of the companies are settling without admitting the guilt. Yeah, and debar from carry out the activities till the further order. So there are uh, many regulatory, I mean, the penal provision if the company uh, violates the rules and regulation or fail to take the disclosure or the protecting the investors' interest. Yeah. So I leave it at this place. Uh, a couple of things that we have seen is origin and evolution of the corporate governance, the purpose of the corporate governance, the basic tenets of the corporate governance, that is strategy part, and the balancing. The board has to balance when the governance of the company comes, because a lot of other stakeholders have a stake in the company, and therefore board cannot unilaterally uh, focus on the shareholders or the employees kind of a thing. And then we have seen some of the governance issue, how they may affect, they adversely affect the interest of the shareholders, and what are the logically so the regulations which are protecting the investors' interest. I thank you for listening to me patiently. I am now open to if you have any questions. Thank you very much. I have how and why do you think corporate governance is important? One is, I mean, if I can directly say without getting into the details or logical this thing, it reduces your cost of funds. If your reputation is high in the way you uh, balance or the work for the various stakeholders and shareholders, the market looks at you. Market always assessing your way of business, and therefore it reduces your fund. But that is a very narrow view. Broadly, yeah, it creates a kind of impression of a socially responsible corporate citizen. Yeah. So generally, if we see in India, yeah, we are hardly paying, we are not paying fully the price for what society gives or what the government gives. Let's say power, water, environment. Yeah, you can't repay. Yeah, so therefore, a good responsible citizen will. I mean, if you can look at the papers on the ESG, why ESG ranking are being taken very seriously by the institutions, yeah, because of the responsibility to the fellow beneficiaries. And therefore, those who are doing good with the CSR, those who are doing good with ESG, we believe they will be good, doing good to the companies also while doing their business. What are the corporate governance regulations for related party transaction to maintain transparency? Yeah, I had skipped that part, but there is a lot happening on that front. There is an industry standard forum which was been set up, and their the report is notified also by the SEBI, saying that those who are dealing with the related parties have to disclose this. Yeah. So there is a detailed disclosures which needs to be given to the audit committee and the shareholders for the approval, because the material related party transaction, I'm not going right now into the details of what is that materiality is, but the material related party transaction needs to be approved by the auditor. So far, there was not an adequacy of the kind of the disclosure which were made to the auditors. And many a times the industry has also aired their views that the disclosures which are required are a little too many or costly. So therefore, industry standard forum, which was a kind of constituted with CII, FICCI, and the industry representation, and then they have submitted their reports, and that requirement has been notified recently by the SEBI. So when it goes to the audit committee for approval, material RPTs, the independent members in the audit committee should approve. Yeah. So essentially, no related party should be there, or no other non-independent member of the audit committee should be there in approval. When it comes to the shareholders' approval, also the related party who are defined or who are considered as a related party under the related party transaction definition under 188, basically that is the mother section in the Companies Act for RPTs. In that also, the related party should not participate in approval of the related that transactions, and often those transactions are to be approved a prior, yeah, before they are undertaken. And many a times people are also raise a concern about secrecy or confidentiality of some of this. But one thing is there that we see generally the related party transaction in a negative manner. It can also be a very positive also, because I have a trust or I have a comfort with a particular supplier. Therefore, I might have invested into that particular supplier. Yeah. So in that case, that related party transaction is beneficial also. But in the recent one, the recent changes that ISF, Industry Standard Forum, they say that you have to certify that this is in the interest of the company, whatever be, I mean, whatever be the terms and condition of the transaction, and that becoming a related party, not necessarily they are bad. Yeah. So this should be in the interest of the company, then it will go for a further approval. I hope that is clear. What is the responsibility of independent director in corporate governance? Yeah. One, I would say they have to raise the voice whenever they find the decision is not in the interest of the company. That is one. Saying that, they should not consider that if the board is dominated by the promoter, that okay, we have raised our points. Now it is up to promoters what they want to do. No, it is not that. They are not the servant of the promoters directly. Yeah, they should not be subserve the promoters director. Then the whole independence is in a question. They have to take an independent decision about that. This is in the interest of the company, and therefore this should not be done, or this should be done. And many a times it may happen that independent directors are one or two, and the rest of them are teamed together. Yeah. So therefore, we have now a kind of provision which says that independent director should meet separately, so that I know the other independent directors' view, and whether and how we should raise our voice as a collectively as an independent director group. So independent director is very important because they are considered to be unbiased. Promoters are biased. Management faction is also biased. Yeah. But these are the people who need to, who are supposed to look at interest of the company. Though promoter also, in all said and done, for a long term, and therefore the one of the positive side of Indian businesses, because it has the group of promoter, is that they can take this generational view. They can take a long term view. If the management is there, management generally go for a short term. Yeah. Quarter to quarter, quarter to quarter, and that they may sometimes lose the focus. What is their stake in the company? Not as much as the generation, the founder family has interest in the company. Often, there is no categorical statement, but often. So therefore, many a times we find the promoters, because of the family founder, the family faction, they take a little longer view, and that often is in the interest of the company, avoiding the short-term upheavals. Yeah. Any other question? So can you please give me the roadmap to become a fund manager? Maybe you can have it little separately. That is not uh, the, the agenda for this discussion. If IBC also part of corporate governance, it seems to be a broad term. Is anything related to companies excluded from the corporate? I mean, I look at the Sir Cadbury's definition. Corporate governance is the way you govern the company. Little definition, but it includes everything. So therefore, anything related to the company is included in the corporate governance. Ultimately, it finally affects the outcome. So uh, there is no limit to it. You can have those basic tenets, uh, strategy, then not the accountability, then the fairness, then the ethics, then the other compliance with the law of the land. Yeah. So that is one. So which part of the company's use CSR fund account is put before net profit? In which part of the company's used fund account is put before the net? I don't understand the question properly, but many times we have we do this create a fund for the replacement. So similarly, you allocate earmark certain funds as per the CSR norms. How much percentage of the net profit should be spent in CSR? That needs to be carved out, and as and when within the time limits you have to spend on the eligible uses, eligible investments. Hello, sir. My question is, what if I like company, but its governance, corporate governance is bad? Should I buy or not? Uh, will you buy a damaged car packed in a very good gift packet? Yeah. You know that it is attractive. Gift packaging isn't attractive, but at the same time, you know that the piece is damaged inside. Whether you buy it. Yeah. I think you have got your answer. Yeah. If you want a very straight answer, no. Please answer it. It's most important. Anant Patel. What are the key pillars of effective? Yeah, sorry, I might have missed perhaps. Yeah. What are the key pillars of effective corporate governance, and how can companies ensure they are upheld in practice rather than just in policy? Very important. Yeah. So I would consider, in fact, I wanted to put the heading of that slide is key pillars, as you have rightly said, but I put basic tenets of this. And again, I repeat what I had said when I had tried to explain that slide. Strategy. Yeah. The first thing of the corporate governance is the company should survive. Yeah. And not only survive, it should go in a direction where it enriches the other stakeholders. Yeah, in a long term. Yeah. So first, those the 5 pillars I would put, uh, 5 or 4 pillars I would put, as I have put it in that slide, is the strategy and the direction. That is first thing. Second is performance, that is accountability for the use of the corporate resources and the societal resources. So performance and the risk uh, you have to take care of. Third, you have to treat the stakeholders in a fairness. Yeah. So if you are not doing that, your company will not travel far. Yeah. The third, fourth is the ethical ethics. Yeah. You look at the companies which have lived longer in the history. If you see the evolution of those companies, yeah, you will find they were ethical in nature. Yeah. They have done the business with ethics. Yeah. So ethics is yet value-based culture. And finally, the compliance. Uh, Because the compliance is more visible, it is easier to implement. Therefore, we find a lot of emphasis on the compliance these days. Not these days, from early days also. But that is also very important, and that is linked to the perhaps the ethical behavior. If you are ethical, then you have to perform or you have to oblige to the laws of the land. So that is how these pillars are there. And how can company ensure they are upheld in this practice? The board has to stick to that. Yeah. The company is an artificial body. It is driven by the management if the board is silent. It is driven by the promoters if the board is a silent spectator. No, the board has to adhere to these five principles, pillars, uh, to make the company run for the larger interest of its stakeholders and the society. So therefore, we find a very strong board, yeah, will be very helpful in economic growth at a larger level. Yeah. You create a culture. Yeah. It is the management, it is the board who creates a culture by saying no to something and saying yes, and not only yes, insistent on something which is right for the company and saying flat no. Yeah. Because the board has to balancing this is important. I hope I have cleared that. Can I certificate hello somewhere? Why do you think corporate pillars? My question is from which book is the best and relevant to make one unable to know the difference between good and bad corporate governance in investment making decision? A particular book may not be helpful. Yeah, you may go through the various books which are available on corporate governance. They are generally written from the checkbox point of view. These are the various compliances, and you have to go through. These are the various laws which are required to be complied with. You need to look at some of the research which are which are getting into the company, which gets into the company and see the decision making and the value system, the core of the company, the book which explain you the core of the company. One of the first of its kind I found was Jim Collins' Built to Last, and it was a Harvard Business Review project for the 5 years and then 5 to 6 years, and then they come out with this. Uh, then the second edition was the Good to Growth. This will give you what is the culture of the company. And some of the other books which you find a kind of a biography or kind of this Piramal's business Maharajas. You see how the company evolved, yeah. Culture evolved. You can't have a very formula for getting into a good culture. Those kind of thing doesn't happen. It's the wisdom. The first slide which I started with was the wisdom. Wisdom is the mix of your understanding of theory and conviction of the practice. So many books which generally give this kind of flair, they are otherwise for the knowledge purpose. You may have various books on corporate governance. And you may look at OECD material. That is also good. Uh, OECD material, I think, by the by far it is the standard one, and it keeps on updating itself. the book, you will see that it would be outdated perhaps, or that kind of some biases also might be there of the author. Look at the OECD material, look at CGCF kind of corporate governance forum is there in US. So that is,
Thank you
yeah.
so much,
Yeah.
Dr. Jinesh Manchali, sir, for such a wonderful and informative session. We truly appreciate your time and valuable insights you have shared with us today. Thank you all. Have a great day ahead.